this is forexbrokers.net, and we finish now the video section, or the two videos dedicated to Fibonacci ratios and Fibonacci levels. We look so far at a couple of ways to treat the 61.8, the golden ratio, and the other retracement ratios. And we stopped at the gold here on the monthly chart with its consolidation around the 38.2. And I want to make an important point here that I also made on the article coming together with these videos. Whenever you have enough data on the monthly time frames, use Fibonacci retracement levels, because the levels or the support and resistance provided on the monthly time frames, they are more important than the ones on the daily chart or on the 4-hour chart and so on. As a rule of thumb, the bigger the time frame, the stronger the support and resistance. Here on gold we saw a dramatic move higher from 1997 all the way to from 1997 from the 251 level all the way to almost 2000. And then, for whatever the reason, in 2011 it moved lower, bursting through 23.6, finding support at 38.2, and then started to consolidate. Now the idea here is obviously not to trade the monthly chart, because no one has the power and the patience and the will to trade a monthly chart, except some investors with big accounts, and they simply just have all the time in the world to wait for the market to reverse. But the idea is to note the support level here, to see that the price action has difficult time letting the 38.2 level go, and then to go on the lower time frame and see or check reversal patterns that might form on the lower time frames. This looks like a head and shoulders pattern, more precisely with an inverse head and shoulder. This would be the left shoulder, a dip low at the head, a move higher on the head, the right shoulder. And even though it took more than 70 months for this consolidation, when it broke higher, it broke higher, and it broke higher from a pivotal 38.2 retracement level. The lesson to learn here is that retracement levels act as support and resistance on the monthly chart and so on, and we should not ignore them, but we should look for reversal patterns on those levels. This is the Great Britain pound and the US dollar. All these charts you can find on the article that comes with this topic, but I simply want to add some words behind them. Maybe you will have a better understanding, and it will help with understanding the concepts. In any case, for any question, I'm available. Just drop a question and send an email, a message, whatever, and we can discuss it. Another way to use the Fibonacci retracement area, according to the Elliott-Wave theory this time, is to find the 61.850 retracement, and then to mark it, to wait a pullback on that level. We see that the Great Britain pound US dollar dropped all the way to 1.14 in March 2020, but in doing that it formed a triple bottom. If you take this vertical line from here, we see that the market bounced from 1.1440 one time, two times, three times, triple bottom, and then on the way up, it broke this previous lower high. So on a bearish trend, the market keeps forming lower lows, lower highs, lower lows, lower highs. This one was the end of the triple bottom, no lower low, and the bounce higher broke this series. That's bullish. Now, you have two options here as a trader. Either you go on the long side by the time that the market broke here, but this is not quite the perfect entry. But let's say you go on the long side, and then you wait for 61.8, 50% retracement to come to add on that long position. Or if you're not afraid to miss the move higher, you simply wait for the 61.850 to go on the long side. So the market dipped here a great area to go on the long side. Stop loss at the lows of the triple bottom. By the way, talking about triple bottoms and triple tops, as a matter of fact, they rarely hold as patterns. This way or this time it did hold, but usually they fall when the price puts a triple bottom, it forms a descending triangle, or when it is able to put a triple top, it forms an ascending triangle, something that we already discussed on a previous article here on this Trading Academy. Another way to use Fibonacci ratios refers to some ratios that are not necessarily Fibonacci ratios, but some ratios that you can edit, or we can add to the tool by editing the tool. So if you select the tool, make right click, and you go on the Fibo properties, you can add here any level you want. For instance, let's add one. Let's add, this is 0.8, I added earlier. Let's add 0.95, just for the sake of it. And at the description, 95, okay, it appears a 95 level. So you can edit this one as much as you want. Why is this important? Some trading theories, like the Elliott-Wave theory, further divides the Fibonacci, or the distance between the Fibonacci ratios, into smaller intervals. For instance, this is 61.8, which is a Fibonacci number, and this is 123.6. If you go and take a Fibonacci ratio and you measure the distance between the two, like this, you see that this 80% is more or less around the golden ratio. This is a very important concept, because the more you go on the lower time frame and you divide the segments, the more info you get. For those studying the Elliott-Wave theory, there is a more detailed explanation regarding this phenomena. But the 80% here makes an important statement, because flat patterns retracement is minimum 61.8 of the previous segment. But if it goes more than 80%, like it did here before bouncing, if it goes more than 80%, the entire expectation for the future price action changes. This cannot be a flat with a double failure anymore, for instance, but it could be a common flat, or it could be an elongated flat with a strong B, with a normal B or a strong B.